It is now being circulated across financial circles that President Trump has chosen Ripple as part of a 21st century modernization effort for banking infrastructure. And whether you believe the optics or not, the conversation itself tells you how serious this shift has become. We're looking at new commentary from Lord Belgrave outlining how Ripple and the XRP ledger were referenced in confidential intergovernmental discussions, not as a flashy consumer brand, but as the invisible settlement layer beneath institutional systems. That distinction matters. According to the description of the briefing, the operating assumption was simple and strategic. End users would never see the raw rails. Banks would continue to present their own branded interfaces, their own balance sheets, their own trusted names. The infrastructure underneath would be standardized, interoperable, and capable of real-time cross-border value transfer once compliance and identity frameworks were synchronized. In that context, Ripple and the XRP ledger were described as plumbing, not storefront, and that aligns precisely with how major institutions think about technology. They do not market rails, they market services. The rail only needs to function efficiently, quietly, and at scale. If that model unfolds as suggested, millions could one day interact with systems powered by XRP without ever hearing the word XRP. From a design perspective, that invisibility is not a flaw. It is the objective. At the same time, commentary amplifying these claims has gone further, asserting that President Trump selected Ripple specifically to help modernize the financial system. Those statements connect broader political messaging about upgrading outdated banking infrastructure with Ripple's positioning as enterprise blockchain plumbing. It is true that Trump has spoken about modernizing financial systems and ensuring the United States remains competitive in digital asset innovation. It is also true that Ripple's CEO, Brad Garlinghouse, has repeatedly emphasized that Ripple's goal is not to replace banks, but to upgrade them, integrating blockchain settlement into existing institutions rather than displacing them. That philosophy mirrors the briefing description almost perfectly. However, it is important to separate interpretation from verified fact. There is no official public evidence confirming that President Trump formally chose Ripple or XRP as the designated infrastructure for U.S. banking modernization. No executive order, no signed directive, no legislative text explicitly naming Ripple as the chosen rail. The narrative is built on alignment of incentives, thematic consistency, and referenced briefings, not on an announced government contract. What we can say with certainty is that the broader conversation around digital asset regulation, including discussions often associated with proposals like the Clarity Act, reflects a push toward defined frameworks that could enable interoperable blockchain settlement at scale. If regulatory alignment arrives, infrastructure that has already positioned itself as neutral, interoperable, and institution-friendly stands to benefit. Whether Ripple becomes that dominant layer depends on adoption, compliance, clarity, and global coordination, not on social media declarations. The takeaway is not blind confirmation, but strategic awareness. Infrastructure revolutions rarely arrive with loud branding. They arrive embedded, abstracted, and eventually taken for granted. The real question is not whether the public sees XRP. The question is whether the institutions quietly build on top of it. The post that was shared blends together verifiable themes with speculation and insider-style assertions, and I want to be very clear about what can and cannot be confirmed. There is no public document proving every claim being circulated, and I cannot independently verify the confidential elements being referenced. What can be verified, however, is that every time the White House convenes discussions about the future of digital asset regulation in the United States, Ripple is consistently present in the room. That matters. Whether the meeting is large or small, whether it is a public roundtable or a closed policy discussion, Ripple has repeatedly secured a seat at the table. When conversations extend beyond domestic borders into the US-UK transatlantic partnership framework, Ripple appears again. When meetings are held at Downing Street to discuss financial modernization and digital infrastructure, Ripple is in attendance. You do not see that pattern by accident. Across jurisdictions, across regulatory bodies, across policy working groups, Ripple continues to surface as a participant helping shape what the next era of financial rails may look like. Some call that coincidence. I do not. When the same company is invited into strategic discussions across multiple sovereign environments, it signals relevance at a structural level. This is how institutional shifts occur. They do not begin with loud retail announcements. They begin with quiet policy alignment, with technical consultations, with advisory input that gradually molds the framework. The invisible hand often operates in plain sight, and in this narrative, XRP sits beneath the visible brand layer, not as a consumer app, but as infrastructure. That distinction is important. Infrastructure is not marketed to the masses. It is embedded, standardized, and eventually taken for granted. If Ripple is consistently advising regulators while also building enterprise-grade blockchain rails, the alignment becomes difficult to ignore. Whether that evolves into dominant settlement infrastructure remains to be seen, but the pattern of engagement is undeniable and worth paying attention to as the regulatory architecture continues to form. Now, this is where the European ledger narrative enters the discussion, and again, we need to separate confirmed policy direction from industry interpretation. Reports have circulated claiming that XRP, Algorand, and Stellar were verified as compatible with a broader European shared ledger initiative designed to unify central bank money, commercial bank money, tokenized securities, and digital assets under a single programmable framework. Conceptually, that aligns with ongoing efforts by the European Central Bank to modernize its Target 2 and T2S settlement infrastructure into something capable of operating around the clock while supporting tokenized instruments. The idea is straightforward but powerful. Transition legacy security settlement systems into distributed ledger-enabled rails that can process tokenized bonds, cash, and assets in one interoperable environment. Industry write-ups interpret compatibility recognition as validation that networks like the XRP ledger could function as settlement layers within that broader infrastructure. While official ECB communications focus on interoperability and experimentation rather than exclusive adoption, it is accurate that pilots and technical trials have explored how distributed ledger technology might integrate with existing European systems. How this ultimately unfolds depends on regulatory coordination, digital euro development, and cross-border harmonization. At the same time, activity on the XRP ledger itself is expanding. Stablecoins denominated not only in US dollars but also in euros and Brazilian real are launching, and additional currency initiatives, including digital yen discussions, are circulating. The introduction of permissioned decentralized exchange functionality has enabled auto-bridging through XRP as the native asset, potentially offering efficient liquidity routing between stablecoins. That mechanism positions XRP as a bridge currency within its own ecosystem. The growth of multiple fiat-backed stablecoins on the ledger reflects an attempt to create a multi-currency liquidity environment where XRP facilitates movement between pools. Whether that scales meaningfully will depend on adoption volume, regulatory clarity, and institutional participation, but the structural pieces are being assembled in real time. All of this intersects directly with the broader regulatory narrative in the United States, particularly surrounding proposed legislation commonly referred to as the Clarity Act, which many believe could serve as a defining moment for XRP and its long-term market structure. The central argument from advocates is straightforward but powerful. If XRP receives formal classification as a digital commodity rather than existing in regulatory gray space, a significant risk premium that has suppressed institutional participation for years could begin to dissolve. Markets price uncertainty aggressively, and regulatory ambiguity has historically limited how pension funds, asset managers, and conservative banking institutions interact with digital assets outside of the established leaders. If XRP were placed on equal legal footing with Bitcoin and Ethereum inside the United States, it would fundamentally alter the compliance calculus for large allocators. Many institutions are not philosophically opposed to XRP, they are operationally restricted. Legal clarity reduces friction, and friction reduction invites capital. That is the thesis driving projections ranging from modest catch-up moves relative to other large-cap digital assets, all the way to more aggressive valuation models tied to systemic liquidity usage. The deeper layer of the argument focuses on function rather than speculation. If XRP were utilized as a bridge asset for large-scale interbank transfers, particularly in domestic settlement corridors, the depth of liquidity required to minimize slippage on multi-billion-dollar flows would imply a materially larger market capitalization. At lower price levels, significant transfers could introduce volatility through order book impact. At higher nominal prices with expanded liquidity pools, the same transfers become smoother, more efficient, and less disruptive. That mechanical reality fuels some of the more ambitious price scenarios, though it is critical to recognize that such outcomes depend entirely on real adoption, not legislative labeling alone. At the same time, tangible developments outside the United States are adding weight to the broader utility narrative. The Dubai Land Department's progression from pilot to phase 2 of its real estate tokenization initiative on the XRP ledger represents more than symbolic experimentation. While the dollar amounts currently involved are small relative to the trillions in global property markets, proof of concept within a government-linked framework carries strategic significance. Tokenizing real property, issuing regulated digital representations, and enabling controlled secondary trading demonstrates that distributed ledger infrastructure can handle compliant asset transfer without dismantling oversight structures. This is not a speculative NFT marketplace. It is a structured environment involving custody layers and regulated access. For policymakers in other regions, including Europe and Asia, the project offers a working template. It shows that real-world assets can move onto blockchain rails while preserving identity checks, regulatory guardrails, and transactional transparency. When legislative clarity narratives in the United States intersect with operational experimentation in jurisdictions like Dubai, the conversation shifts from theory to architecture. The question becomes less about whether tokenization is possible and more about which networks are positioned to support it at scale. Beyond payments corridors and property tokenization pilots, the conversation is clearly shifting toward yield infrastructure built directly on top of stablecoins operating within the XRP ledger ecosystem. This is where the strategy becomes more sophisticated. A stablecoin like RLUSD is not just being positioned as a transactional medium for cross-border movement, but as a base layer for regulated yield generation tied to real-world assets. When vault structures are introduced that allow RLUSD to be deployed into pools backed by instruments such as private credit facilities or tokenized U.S. treasuries, the stablecoin begins to resemble a blockchain-native fixed income wrapper rather than a simple settlement token. That distinction matters enormously for institutional capital. Funds, treasuries, and banks are not looking for speculative upside in the same way retail traders are. They are looking for predictable yield, capital preservation, and compliance alignment. If a dollar-backed stablecoin can offer regulated exposure to traditional yield-bearing assets while remaining fully on-chain, it bridges two financial worlds that have historically operated separately. Early vault capacity filling quickly indicates there is appetite to test that structure, but long-term viability will depend on transparency of underlying assets, regulatory oversight, counterparty trust, and consistent performance across market cycles. Zooming out, the broader theme remains institutional positioning. Ripple's direction appears deliberate. Regulated rails, regulated liquidity, regulated yield. That is not the blueprint of a meme-driven cycle. It is the blueprint of infrastructure seeking integration with existing financial architecture. At the same time, market analysts continue examining long-term technical structures, drawing Fibonacci extensions from prior cycle lows to historical highs, and comparing those levels with forward projections issued by established institutions like Standard Chartered. When independent technical models align closely with institutional research targets, it creates narrative confluence, and narrative confluence often amplifies market psychology. That does not guarantee price outcomes, but it strengthens conviction among participants who track both macro structure and chart-based signals. Adding to the speculation cycle, commentators such as Paul Barron have suggested that additional developments tied to regulatory clarity and Ripple's ecosystem expansion may be forthcoming. Whether those hints materialize into concrete announcements or fade into typical media buildup remains uncertain. What is undeniable is that the structural components now being assembled extend well beyond simple payments use cases. Policy engagement at national levels, cross-border interoperability discussions, stablecoin liquidity layers, tokenized real-world assets, and yield-generating protocols are converging into a single ecosystem narrative. If that convergence translates into measurable transactional volume and sustained institutional usage, XRP's role could evolve from cyclical speculation to embedded financial infrastructure. The ultimate outcome will not be determined by rumors or projections alone, but by adoption metrics, regulatory finality, and whether real economic flows consistently choose these rails over legacy alternatives.